Good morning, everyone. I'm deeply honored to stand before you today on the occasion of this 8th anniversary of the Paris conference, and allow me to extend my heartfelt gratitude to the International Economic Forum of the Americas for their gracious invitation. It's a pleasure for me to be back in the forum. I'm currently the chair of the Cour des Comptes, and also I'm presiding the High Council of Public Finances, the French independent fiscal institution, and before that I've been finance minister quite a few years ago, and commissioner for economic and financial affairs, taxation and customs in the EU. And as such, I'm a strong believer in the European project and in its path forwards, sustainable growth based on strategic autonomy and the green transition. I hear growing concerns about the struggle of investment within an increasingly uncertain world. What I would like to do is therefore use the few minutes I have to share my views on the economic challenges and the geopolitical tensions currently affecting Europe. To be blunt with you, I won't surprise anybody, we are currently living through extraordinary levels of uncertainty. I would like to quote my old friend and former president of the European Commission, Jean-Claude Juncker, by saying that we are currently living as Europeans in what we call a polycrisis. That means that we have all the crises all together. I identify four main challenges: the economic situation, climate change, the geopolitical crisis, and the fragility of our democratic foundations. First, the economic situation. The COVID-19 pandemic was the most significant and disruptive shock of the decade for both the global and the European economies, and evolved into a multifaceted challenge of immense magnitude, causing disruptions in supply chains, particularly in energy, with import prices doubling between 2020 and 2021. The inflationary trend persisted due to the ongoing consequences of the war in Ukraine, which is not over, which also severely affected our supply of fossil fuels, raw materials, and essential food products. The fiscal strain of our economies, and this is certainly the case here in this country, France, remains significant. Efforts made by member states have been increasingly challenged by interest rates, leading to an escalating debt burden. In France, for example, debt servicing is now the second largest public expenditure just after education. And if this trend continues, it will be the first in just a few years from now. This constraint is particularly troubling at a time when massive investments are required to finance the green and the digital transition, critical for achieving long-term economic sustainability and technological innovation. Consequences of climate change, you discussed that, are numerous: reduced water availability, lower crop yields, loss of biodiversity, forest fires, heat waves and floods. And these impacts affect many aspects of our lives, from public health, jobs, and the quality of life for vulnerable population, to industry, agriculture, and the economy. While public funds are essential for developing green infrastructure and to ensure also climate policy credibility, they also cannot meet the vast financial requirements of achieving climate neutrality. And to bridge this gap, the EU must absolutely leverage private capital, making private investment a critical component of the transition. And this reliance on private funds implies that European frameworks such as InvestEU and the European Green Deal must create a regulatory environment that incentivizes private sector participation, reduces investment risks, and promotes collaboration between public and private actors to ensure the transition is both financially sustainable and effective. At the same time, we are facing a geopolitical crisis with the return of high-intensity warfare on our continent since February 2022, which calls into question our strategic independence. This war represents the greatest threat to the European democratic space. And let us not forget that the number of casualties since the beginning of the conflict recently reached 1 million. Geopolitical tensions, including the ongoing war in Ukraine, but also conflicts in the Middle East have placed a strain on our economies and tested our resilience. As the shadow of Ukraine fatigue looms over Europe, it is indeed becoming harder for the European nations to find a resolve to sustain their military and economic efforts in support of Ukraine. We need to do that. And this will be the task of the new institutions that now take place at the European level. Finally, a lot of uncertainties come from our political and democratic situation. The political landscape we know today is a result of multiple dynamics. It has been shaped by the rise of Euroscepticism in many European countries, and it culminated in the UK with the Brexit. It has also been shaped by another tendency that we call illiberalism, a mix between democracy, we vote, and also lack of freedom, which exists in some European countries and tense others. It is impossible to discuss European sovereignty and power if the people of the various member states are fragmented, not relating to the European project. And this is why the topic of democratic resilience is key, because it conditions the very existence of the EU. We will have also to cope with the new American power in a few weeks from now. The US are our friends and allies. We also know that things will be maybe more difficult, and we need still to try to build as much as possible good relationship, but also be capable to respond to some aggressivity towards us. Out of this quite bleak picture, I must say, what can we do to oppose these tensions and to be able to gain confidence on the future of our continent? First, recent reports by Mario Draghi and Enrico Letta underscore the urgent need for Europe to reclaim its strategic autonomy and to reindustrialize through massive investments. As global competition intensifies, Europe must invest heavily in innovation to bridge the gap with economic powerhouses like China and the US. To achieve this, we must expand our fiscal room for maneuver. That means ensuring that budgetary constraints do not hinder the scale of investments required for long-term success. That said, addressing the issue of strategic autonomy requires a comprehensive approach. Investments should not only focus on fostering economic growth, but also integrate climate change considerations. We must ensure that sustainability and environmental responsibility are embedded in future investments. To do so, Europe must prioritize not only economic resilience and innovation, but also recognize that the green transition is key to achieving our strategic autonomy. But I will not lie, the resources that we will need to be mobilized to face the realities of trade tensions and climate change are very significant. This is why it is absolutely essential that we build a robust and comprehensive response and cohesive. In that spirit, initiatives regarding the share debt, meaning the capital markets union and a fully realized banking union, still play a critical role in strengthening the foundations of the EU. And we must explore these paths further, and this is certainly on the agenda of the future Commission and the other powers. Next Generation EU has set a precedent for a united, bold approach to recovery and investment. Its ambition to support economic growth and resilience through loans and grants reflects a near Hamiltonian moment for Europe, but the capital market union is a necessity, is instrumental to enabling better distribution of investments, particularly for green and digital transition. My message is that we must not forget the green transition in the new picture. But to lead all these changes and ensure prosperity and stability in a rapidly changing global landscape, it's also about politics. And we need a united Europe. That is key. I emphasize the term united because, as you know, we are also facing a significant geopolitical crisis that demands our constant effort in maintaining a strong cohesion. The challenge is a great one. And adding to this economic difficulty, the conflict is raising growing concerns regarding the erosion of our democratic values. In the same vein, situation in the Middle East continues to divide us, the Europeans, highlighting the shortcomings of our diplomacy and our ability to speak with one voice when addressing complex regional conflicts. And the role of Madame Callas, the new HRVP, is key there. To sum up, on all fronts, Geopolitical tensions continue to challenge our unity and to strain our resilience. To remain strong in face of these challenges, it is therefore imperative that we uphold to our democratic values, working together to ensure unity in the face of adversity. In a world marked by complexity, by uncertainty, the path forward for Europe lies in unity and shared vision. I'm quite optimistic because, to end with, I would like to quote Jean Monnet, one of the founding fathers of the European Union, who said Europe will be forged in crises and will be the sum of the solutions adopted for these crises. Since we have so many crises, we must have solutions. One more word, since you are in Paris, here in France. I know that some might be worried about, let's say, the instability, the fragmentation, the uncertainty of, as well, the political, economic and financial situation. I know that. And we need to act on that. We have now a new Prime Minister. He will try to do so. We will need to help him. Institutions like mine will help him. But this is a good country, and you must trust France and trust in France. Thank you very much.
Well, thank you. Thank you very much. I'm very happy to be doing this session, especially with you, Christophe, because your company, you really have skin in the game, and you have money to work and put to work, which is not always the case for everyone. And you also work, and this is very important, with more than 600 companies across Europe. So you have a very European vision of this. I think, and I would be wondering also what your take is. This is also a very particular moment because when you look at the report that Mario Draghi put out, he said very clearly Europe has to radically change or there will be a form of slow agony and decline. So I wonder, and nobody likes decline, so I wonder, how do you see the business landscape in Europe as we enter 2025?
You know, it's, well, first of all, thank you very much for this introduction. And yes, we, at Eurazeo, we finance directly 600 companies based in Europe. The reason why we are financing them is because we think that these companies are able to grow faster than average. An investment firm like us, we don't create value by our own. We only create value if we put our money at work in companies that are growing faster than average. The beauty for us today, whatever the political environment is in Europe, the beauty for us is that today we are financing 600 companies all over Europe. We tend to believe that there are much more interesting companies than that needs to be financed in Europe, that need more capital to accelerate their growth.
And can I ask you, going back to the title of the session, what is a European champion to you? Because I think sometimes we have a temptation to look at the big listed European stocks, of course, names that we all know. But the reality is a big part of the European economy is in the mid-tier sector. And not only they make a lot of things, a lot of good things, but they also employ a lot of people. So I wonder, what is your definition of a European champion?
It is a clear difference. When you think about the European economy, when you compare it with the US, when you compare it with China, or even if you compare a country like Korea to Europe. In Korea, you have a dozen of very large conglomerates, and that's about it. The number of mid-market companies is relatively limited. Europe is entirely the opposite. In Europe today, you have a population, it's a patchwork, it's still a patchwork, it's still a local patchwork, but you have an incredible patchwork of small and mid-market companies. This is a clear strength of Europe. It's not a weakness, it's a strength. Because these companies, if you help them to accelerate, they are what we call the hidden champions of Europe. And if you finance them well, they are able to become worldwide leaders, maybe still in their niche, but they can be worldwide leaders.
And there's something, however, I want to ask you, because oftentimes when you talk to companies that have that ambition and that aspiration, they do say accessing funding and doing business in Europe is still difficult, and it's difficult, much more difficult compared to other jurisdictions. I wonder, is there an element of exaggeration to that, or actually would you say, well, the reality is they're right, it's difficult for the startup?
It is difficult. It is difficult, and it is an issue, and yet we hope that the Draghi report will help all of us to take this into consideration and accelerate change. Because the beauty of Europe is that we have a lot of savings. We have a lot of savings. Each one of us in this room, we probably have a lot of savings. And Europe as a whole is saving a lot. But where is this savings invested? Not always in what is called the real economy. And what is difficult also is that these small and mid-market companies that we are talking about right now, they don't have access to the capital markets, to the stock exchange as it is. For example, when you think about innovation, you are always we are investing a lot in venture and in growth capital. So we are financing digital innovation, biotech. We are financing companies that are accelerating very fast because their business model is based on innovation. Europe is still incredibly good at that. It's not the capital market who are financing this kind of companies. It's not adapted. It's not the case in the US. Venture and growth equity in the US is not financed by capital market. It is financed by, as Mr. Moscovici was mentioning, by private finance, by private capital. And private capital in Europe is needed. We are probably one of the largest investors in continental Europe in venture and growth. But there is much more companies to be financed than what we are currently financing. And when you look at the success, for example, of Mistral, when you look at the success more locally here in France of Doctolib, there are plenty of very good innovations that is born in Europe. But when you look at the difference between, for example, if we stay on this idea of innovation, which are relatively small companies at their beginning stage, at the early stage. When you think about that, Europe is not lacking of very good innovation. We have very good innovation in healthcare, in artificial intelligence, in the digital space. We are not lacking very good entrepreneurs. The younger generations, they are incredibly dynamic. They are trained to develop global business models, so they are at the top level. Some of them have been trained in the US. They maybe have started to businesses before in the US. So it's not an issue of quality of the innovation. It's not an issue of quality of the management. So where is the issue? The issue is that sometimes we are financing a European company. The US competitor is doing exactly the same, but between the two rounds of financing, there is a difference on 1-0. It's 10 times more finance in the US than in Europe. At the end of the day, in Europe, we are a little bit naive about this. And this idea that we can help our economy to grow without giving it the fuel, the energy, the euros, the dollars that are needed to make it work, we are a little bit naive on this.
And you said a lot of important things there, because when you said our savings, we save a lot as Europeans, that money goes somewhere else. Of course, you're referring in some large part either to bonds or actually going to the US and stocks. You also talked about young European companies that need the funding, and sometimes they turn to the US. There's no way the Americans would allow that to happen in their jurisdiction. They would never allow money to go out of the US, and they would never allow losing companies to other jurisdictions. So why are we doing that?
Don't ask me why. Maybe we reckon a certain level of Europe is naive on certain financial aspects. And we've talked about innovation. But if we think about more mature businesses, because we are also financing more mature businesses, and when you think today at the reality of Europe, which again is the land of mid-market companies, our neighbors, our friends, where are they working in Europe? They are working in relatively well-managed industrial companies, industrial leaders, niche players in some cases, still probably a relative component of, they're still relatively local. And for example, we finance a company at Eurazo which is called DORC. DORC is involved in medical device. Medical device, it's a niche in the healthcare industry. DORC is involved in medical device for eye surgery, so it's a niche inside the niche. DORC is born in the Netherlands. It's not the largest market in Europe, but they are the number one of eye surgery in Europe. What do you do when you are number one in eye surgery in Europe? You are in a market where the population is aging, where the population is rich enough to get access to the best technology for healthcare and more specifically for eye surgery, but your market, you are not spontaneously growing very fast. We've helped them to conquer the Chinese market because in China, you also have an aging population, a middle-class population that is also requesting to get access to the very best technology for eye surgery. Believe me, I had an eye surgery myself. You don't negotiate, you don't bargain with the quality of the device that will operate, that will do your eye surgery. So we've helped them to conquer the Chinese market, and we have sold them. We sold them to Zeiss, which is a German conglomerate. What have we said to Zeiss? We said to Zeiss, the Indian market is untouched. There is still plenty of growth. So the story of Europe is that you need to finance companies like this one, where you can completely change the profile of the company when you help it to move from a local leader, from a European leader, into the global leader in its field.
And can I ask you just briefly, the idea of made in Europe, I know it's difficult to quantify and put a number, but how much would you say made in Europe still creates a premium for a company? You talked about a Dutch company then that goes to China and gets government approval, which is not always easy. Is that still a competitive advantage in this global world? Do people appreciate made in Europe?
Yes, still, when we think about healthcare, when we think about way of living, when we think about consumption, when we think about food, when we think about luxury, yes, Europe is still full of strong strengths. And let's not be, it happens in Europe that we are very pessimistic. But again, when you are based in China or in India, and when the value proposition of DORC is to tell you, I can give you access to the very best technology for an eye surgery, nobody is challenging that this company is born European. And this is true for plenty of different businesses. So Europe, if we have something to keep in mind, Europe is full of hidden champions that are the best in their categories, but to accelerate growth, you need more financing. You need more financing when your way to accelerate is innovation, when your way to accelerate is internationalization, when your way to accelerate, and it's something that is very powerful in Europe, external growth, buy and build, the consolidation of the European market, it's happening every day. But to do that, you need some financing. You need not only private capital, you need private debt. And last but not least, it has been very well explained by Pierre Moscovici, but also the fourth wheel of growth is that if you adapt your portfolio company, in our case, if you adapt your portfolio company to climate change, and this may require some investment, but if you adapt them for climate change, when you sell them, you are selling a company that is much less risky than when you invested. This is also a way to create value.
And can I ask you, because you and I were talking backstage, and maybe there's also a cultural element, but you did say to me a lot of mid-tier companies still either go to banks, and they're national banks also, or they turn to perhaps a form of family money that has been established. One of the big differences perhaps with the U.S. is that in the U.S., money is money. There's no smart money. There's no dumb money. Money is money fundamentally. Is there something that needs to change also in the European mindset about funding?
It is changing very fast in the mentality of European entrepreneurs. Yes, today, the way you are financed is the key to success. It is true in the US, it is obviously true in Europe. For example, if you are the best managed Swedish company in your niche, and if you are competing with the best managed Italian leader in your niche, if your competitor is family-owned, and if you are backed by an investment firm, if you have access to private debt, to buy and build, to acquisition debt, you have a competitive edge. Because if you only finance external growth with your own capital, with your own capabilities, you may lack of speed. And speed today is very important. When we think about innovation, you have seen that in many topics in the digital space, there is a strong trend, which is to say the winner takes all. And we have seen it in Europe. We suffer from it. We suffer that in terms of engine of search, Google is the winner that takes all. Amazon is the winner that takes all. So the winner which takes all may also be the company that was best financed. So today, what is very clear in the mind of the entrepreneurs that we finance is that the way you are financed, the way you are backed by public capital in some cases, but also by private capital, is a key component to success.
And just to close this part of the conversation, we talked about the early stage of startups, but then there's also a later stage that comes with a company that has already grown big and perhaps needs even more funding and they want to IPO. How do you feel when you see a very young, bright European CEO go and list in the US and say, well, we're listing here because we want to be a global champion? Surely that has to hurt at some point in your heart. But the question is, how do you prevent it? Because we've seen it happen. I don't want to name names, but we saw it happen very recently with a very Swedish important company that I'm sure we all know. And they said it very clearly, we want to be global, so therefore you have to go to the US.
It's, yes. We are not very proud of that. It's true that in Europe today, it's not easy because it's less easy than the US. But you can be financed in your early stage, in your late stages. You can be financed by investment firms that are European, in some cases also international, which is good. But for your very, very best success stories, it's true that the IPO on the Nasdaq is still what it is. On this, it is very important that Europe creates tools to also have capital markets that are able, stock exchange that are able, and also a regulation that is able to welcome more and more companies like that, even if probably the very, very largest global successes, probably the leadership of the Nasdaq will stay for a while.
And I wonder, there's a new, of course, commission that is now has already started work. The tone, it seems to me, the political tone has changed. They talk about the idea of more business-friendly Europe. The European Investment Bank was very clear that European champions have to stay in Europe, otherwise you lose out. I wonder, in terms of the regulation and the spirit now that you hear from the political side of things, do you feel more optimistic? Is this something that you hear and you say, okay, it sounds better than 5 years ago?
I'm a little bit optimistic because I'm optimistic by nature, and also the Draghi report again is showing us where to go. But if there is a regulation that we need to change today in terms of capital market, in terms of where our savings are put at work, I would say the first thing to change in the European regulation is to stop forbidding savings to finance businesses in early stage and in late stage in Europe, because you cannot imagine the number of regulations that today is preventing our savings, all of us in this room, our savings are prevented to invest. Solvency II, for example, I'm managing money for insurance companies for 3 decades. And I can tell you, the private equity investment of these insurance companies have been among the best performers and the less volatile of their investment. Still, the European regulation today, Solvency II, is explaining to a large part of our savings, you can invest in government bonds. Well, for the last 3 decades, there has been only one trend for public debt in Europe, growing. So the business model of public debt in Europe is challenging to a certain extent, but there is absolutely no capital requirement to invest in public debt. You can invest in real estate, whatever the volatility of the real estate market is, but if you invest in private equity, if you invest in venture capital, if you invest in mid-market companies, if you invest in the companies where your neighbor is working, this is very risky. So, luckily, I'm making it a little bit, it's a caricature, but again, a large part of our European regulation is preventing our savings. We are in a region of the world where there is plenty of savings. there is plenty of opportunities to invest, plenty of startups, plenty of big ups, and plenty of mid-market companies that need more money to consolidate and to accelerate internationally. So the first thing that we should change in our regulation is to stop forbidding.
And can I ask you, because of course, in all honesty, you do have conversations, I'm sure, with regulators. You're all over Europe. You were telling me, I'm sure also you have conversations, not just nationally, but also on the supranational level in Europe. What makes you think this time is going to be different? Because a lot of these things we've heard now for years, the Capital Markets Union, the Banking Union, also we've heard this, I think, for as long as I've been alive almost. So what makes you think this time is going to be different?
It's accelerating everywhere. And for example, here in France, when you see life insurance in France is managing a large part of the French savings. For example, we have had several changes in the regulation called Loi PAC, called Loi Industrie Verte, that have helped insurance companies to better diversify their assets. So there is a natural trend, and it's moving in the right direction. We are talking a lot about regulations. There is also a significant change in Europe that I would like to discuss with you, to be optimistic at the end of this presentation, is the fact that I remember when we started this business, when we started to invest in venture and growth capital in Europe, failure was not an option in Europe, and failure was a drama in Europe. Whereas in the US, the concept that you can be an entrepreneur, fail, and try again, and start again, was much more accepted. This has entirely changed in Europe today. It's a strong component of my optimism. We've backed, for example, at Eurazo, we've backed several entrepreneurs where their first startup was not a success. But when you explain today in Europe that you have tried and that you have some lessons learned and that you are trying again, you can still be financed. Whereas probably 30 years ago, our global European way of accepting failure was probably much more dramatic than what it is today.
That's very interesting, because some argue one of the biggest cultural differences is in the U.S., risk at times is rewarded, whereas Europeans, they just like to keep what I have, and if I'm lucky, pass it on to the next generation. But I wonder, for mid-tier champions, let's say, to become real champions, and that means compete globally, do you believe further consolidation will be needed? And I say that because at times, for the public opinion, that word has a negative connotation.
It has a negative connotation, and but for less and less for the younger generation. Yeah? So I'm in private equity again for 3 decades, and I remember when we were in conferences and explaining that we were backing a French company, helping it to acquire in 6 years in its Spanish competitor, and that we were building a multi-local leader in its field. We were the king of the hill. Today, we are financing companies where the management is entirely European day one. They may be based in Milan, in the south of Sweden, or in the north of Spain. Nobody cares. They think global, they think European day one, and they think global. And their teams, their management, the CFO may be German, and the chief of development may be French. They don't care. And this is an impressive change. The younger generation, they think this is obviously true for the digital space. This is obviously true for biotech. No innovation is local anymore. But it is more and more true for the populations you were describing, which is mid-market companies today in Europe. They are ready for that. They are ready to clearly understand that when you are born in the Netherlands, your market is not domestic. It's day one European, and it's European because if you are not the European leader to conquer the Chinese, the Indian, the Indonesian, the Australian market, is going to be very difficult.
And just lastly, and very briefly, if I may, as we're running out of time, but however, this conversation and this positive case, it's coming in a time in which There's serious concerns about Europe's ability to continue with the form of budget consolidation. At the same time, we talk about investing, so sometimes it feels like it's a bipolar concept. Obviously, in France, I know Mr. Moscovici, he talked about you have to trust France, but at times markets, are not that trusting. There's questions about Germany too. The political zeitgeist maybe is not the best, but that is not unusual for Europe either. So what is the positive case that you pitch internationally in a moment like this?
It's always difficult because, part of the job for an investment firm like us is to obviously convince European savings, European investors to better finance European companies. It's also to convince the deep pockets of money that are sovereign funds and pension funds that are today entirely based everywhere in the world. It's always a little bit difficult to sell Europe as a concept. We are not the fastest growing component we are not the youngest population. That's okay. But when you think about the fact, when you explain this idea that Europe is full of hidden champions, that there will be a consolidation of the European market, that this consolidation helps to internationalize, that Europe is still able to deliver some of the best innovations in the world. So the way you explain Europe to international investors today is much more a micro bet than a macro bet. It's, again, an investment firm like us. In a specific investment strategy, we finance 20 companies. So when an asset manager is offering, an index-based fund like the Stock 50, you are selling, a strong correlation with the European GDP. When you are explaining, when you are attracting private money in private equity and private debt asset classes, you are not selling access to the European GDP, you are selling an access to 20 hidden champions, to maybe in some of our most diversified strategy, 30. So definitely the idea is and in total, Eurazeo today, we are financing 600 companies. We are all of us in this room, I'm quite sure we are all of us convinced in this room that Europe today has much more than 600 hidden champions.
Well, you'd think. And on that note, Christophe Bavière, he is co-chief executive officer at Eurazeo. Thank you so much for taking my questions. It was a pleasure. Thanks.